If you're planning to buy a home or refinance soon and you're nervous that stacking 0% business credit will blow up your mortgage, this is for you. I've had thousands of these conversations. The fear is real and it's fixable. Today, I'm going to show you a mortgage safe path to 0% funding, answer every scary what if, and give you the exact timeline so you don't tank your loan. By the end of this video, you'll know exactly what to do, what to pause, and how to still get the capital you need without jeopardizing underwriting. So let's say it out loud. I'm getting a mortgage soon. If I start applying for business cards, my score will drop, my debt to income will spike, the lender will freak out, and I'll lose my rate of my approval. You're worried about hard inquiries, new accounts, utilization, weird transactions on bank statements, and underwriters counting your business debt against you. Good. Those are the right concerns. Now here's the truth. With the right sequence, you can keep your mortgage pristine and still position for 0% capital. So what are the 4 buckets underwriters care about? Number 1, credit score and recent behavior. Number 2, debt to income or DTI on your personal report. Number 3, bank statements during the last 60 to 90 days. And number 4, source of down payment and reserves. Let's break down each one. Bucket 1, score and behavior. Yes, hard inquiries can shave points. And yes, new personal resolving accounts can ding your average age and your score. But here's the key. Most major business cards don't report monthly balances to your personal credit unless you default. That means no monthly utilization hit on your personal credit from those business balances. Your mission is to keep your personal cards ultra low utilization, avoid new personal revolving accounts before closing, and be intentional about hard pulls. Bucket 2, debt to income. Underwriters primarily calculate DTI from debts on your personal credit report. Business accounts that don't report to your personal usually aren't counted. So the caveat is if a business debt does show in your personal report, or if the lender asks about it and you can't document that the business pays it, then it can be counted. Bucket 3, bank statements. Underwriters scan your last 60 to 90 days of statements looking for large cash advances, balance transfers, and undisclosed loans, and non-source deposits. Translation, if it doesn't hit your personal credit, if you dump weird credit-derived cash into the very accounts you're using to qualify, you can trigger questions, but we'll keep those statements clean. Bucket 4, down payment and reserves. Owner-occupied mortgages do not want your down payment sourced from a credit card cash advance. Investment loans vary, but expect sourcing questions. So we plan clean funds for down payments and reserves, and we use 0% capital for everything around the close: marketing, capex, furnishings, and operating runway. So what's the mortgage safe timeline? Here's a simple playbook. You can either pick plan A or plan B. Plan A, you can wait. If you're inside 60 to 90 days of closing and you don't absolutely need capital today, freeze all new credit activity. No new personal cards, no business applications, no odd transfers. Keep personal utilization under 9% per card and under 9% aggregate. Pay before the statement cuts. If your mortgage lender pulls updated credit before closing, you want it boring. Close on your mortgage, celebrate, then start your 0% stack the week after funding. That's the safest path to take. Or plan B, you need capital before closing. If you need capital now, we do a low impact pre-stack with strict guardrails. Guardrail 1, only apply for business cards that historically do not report monthly to your personal bureaus. Avoid business products known to report to personal. The result can be that balances you carry from the business won't show up on your personal credit during underwriting. Guardrail 2, batch applications in one carefully planned season to limit multiple scoring events. Know which issuers pull which bureaus in your state. You'll want to concentrate pulls strategically instead of spreading them across all 3. Guardrail 3, personal profile protection. No new personal cards, no personal balance transfers. Keep personal utilization feather light. If your personal cards are carrying balances, pay them down before statement cut to near 0. Let the score breathe. Guardrail 4, clean statements. Do not move credit diverse cash into the same checking or savings accounts you'll use for underwriting during the final 60 to 90 days. Open a separate operating account at a different bank for business funding if needed. Keep your mortgage docs quiet. Guardrail 5, use of funds. Do not try to use credit card cash for an owner-operated down payment. It will get flagged. Use the 0% capital for marketing, inspections. Earnest money alternatives allow for the contract. appraisal fees, cap X after close, are to build reserves in a separate business account that isn't part of the mortgage asset package. And finally, guardrail 6, documentation. If any business debt payment appears anywhere the underwriter can see, make sure it's clearly paid from the business account for at least 3 months. That lets many lenders consider it business paid, not personal debt to income. And here's some of the most common questions when it comes to getting business credit during underwriting. Question 1, will hard inquiries hurt my approval chances? The answer is 1 to 3 hard pulls. If isolated in time, this will rarely move a qualified borrower's pricing tier if everything else is clean. We keep personal utilization near zero and we avoid new personal accounts. That offsets the small dip. Won't new accounts lower my average age? And the answer is business accounts that don't report to personal won't touch your personal average age. We don't open personal revolvers pre-close. Problem solved. Won't underwriters see I personally guaranteed the business cards and count the debt anyway? The answer is many lenders focus on what's on your personal report. If it's not there and the business is paying the obligations, it's typically excluded. If asked, we provide business bank statements showing the payments and a short letter of explanation. I need to show proof of funds. Can I use 0% cash? The answer is for owner-occupied, assume no. For investment property, some lenders allow business funds if sourced in season, but it's still delicate. The safer option is use personal savings for down payments and reserves, then immediately replenish with 0% after closing. What if the lender does a soft pull right before closing? The answer is no worries. Your personal report stays clean because we don't open personal accounts or spike personal utilization. Any business cards that don't report won't appear. You pass the soft pull. Will my bank statements show weird cash-like transactions? The answer is not if we follow the clean room rule. Business card liquidations or invoice payments happen in a separate business account at a separate bank outside the 60 to 90-day look back of the accounts used for underwriting. What about debt to income? Won't any new payment sink my credit score? The answer is if it's not on your personal report and the business pays it, many lenders do not count it. If something does land on personal, we either pay it off before final underwriting or provide documentation that is reimbursed by the business. Another objection we hear is, I'm right on the edge of qualifying. Any score drop hurts. And our answer is, then choose plan A. Close first, stack second. If you need a small cushion now, we can explore vendor terms, net 30s and 60s, or a single low-impact business line with zero utilization until after closing. Will the mortgage bank penalize me for opening accounts at the same bank? And our answer is we don't stack at your mortgage bank pre-close. We keep those ecosystems separate until you're funded and closed. Another objection is I've heard some business cards do report to personal. And our answer is correct. Some do. That's why issuer selection matters. We only touch products that historically stay off personal reports unless you default. So what if the 0% period starts before closing and I can't use it? And our answer is fine. We secure approvals now. Let the card sit at zero and deploy after funding. Zero balance means zero cost while you close. What if I'm self-employed? Won't this complicate my tax docs? And the answer is no. If anything, it simplifies. Clean separation of business spend, solid bookkeeping, and business paid obligations are exactly what underwriters like to see for self-employed borrowers. So here's the plan you can follow today. Step 1, tell your loan officer the truth. I'm considering business credit for post-closing renovations and marketing, but I'm protecting my personal credit and keeping my mortgage statements clean. You'll sound organized and responsible. Step 2, choose plan A or plan B. If you're inside 60 to 90 days and don't need spend now, just wait. If you do need spend, proceed with the low-impact guardrails. Step 3, protect the personal profile. Pay personal cards down before statement cut. Set auto pay to statement balance. No new personal accounts. No balance transfers. Keep it sleepy, quiet, and boring. Step 4, open your clean room business account. Different bank than your mortgage assets. All 0% actively happens here. The accounts your lenders will review stay pristine. Step 5, selective business approvals. Stick with one carefully planned application session. Stay with issuers that don't report monthly to personal and expect 1 to 3 hard pulls total. Then stop there. Step 6, no cash-like transactions that look messy. Use 0% for real expenses, marketing, professional fees, inspections, post-close, CapEx, furnishings, and don't try to fabricate down payment cash. Step 7, document business paid obligations. If any payment could be seen, pay it from the business account for 3 months. Keep receipts, and if asked, you have proof the business, not you, services the debt. And last, step 8, close on your mortgage. After final credit refresh and clear to close, then you can scale your stack. Request limit increases and add additional business products, then deploy. So here's a quick case study. A recent client had a house purchase in 45 days. They needed capital to launch marketing for their rental business immediately after close. We chose Plan B. We got them 2 business approvals with 1 bureau credit check, no new personal accounts, while their personal utilization stayed under 5. We opened a fresh business account at a different bank, kept their personal qualifying accounts quiet for 60 days. The underwriter pulled a soft refresh, saw nothing new on personal, bank statements were clean, and they were clear to close. 7 days after closing, we finished the stack, moved limits from $40,000 to $160,000 over 21 days, still at 0%. They furnished 2 units and funded their lead generations without touching their mortgage approvals. The results, the mortgage stayed intact, and the capital was secured with a successful business launch. So here's what not to do. Do not open personal cards before closing. Do not run up personal utilization. Do not deposit credit-derived cash into the same account your lender will review. Do not use credit card cash for an owner-operated down payment. And do not mix ecosystems with your mortgage bank pre-close. Stick to these and you'll be just fine. So can stacking 0% business credit ruin your mortgage? If you do it blindly, yes. If you follow a mortgage safe plan, no. You'll protect your score, keep DTI clean, keep statements clean, and use the right cards at the right time. And here's what I'll do for you. I'll map your mortgage safe timeline, choose the right banks, and set up a clean room account strategy so underwriting stays happy and you'll get the capital you need. If you would like to work with me or my team, book a call in the description and I'll give you a custom plan based on your closing date. You don't have to choose between your mortgage and your momentum. With the right sequence, you get both. Let's build it and let's get you funded.